In this video, we will look at DuPont analysis for Coca Cola, stock symbol KO, and Pepsi Cola, stock symbol PEP, over the period 2012 through 2016. DuPont analysis is named for the company that more or less invented or hyped the process of decomposing the return on equity. That the return on equity is the net income per dollar of equity, that's the amount of money the shareholders earn, into component pieces. If we take the net income per dollar of sales and then multiply that by sales over assets, then the sales part drops out of both pieces and we have net income over assets, which is the return on assets. So then if we multiply, I'll use a star symbol in here, I think it'll make it easier to read. Alright, so then if we take the sales, net income over sales, times sales over assets, times assets over equity, assets drops out, and what we're left with is net income over equity. So that's what DuPont analysis does, is breaks down the return on equity into three component pieces. The profitability times the efficiency, as measured by how well we use our assets to generate sales, times the financial leverage. All right, and the financial leverage is the use of debt financing to leverage up the return on equity. All right, if you can borrow money at a cheap rate, then you can, if you can earn more than the interest on the debt, then what you can do is leverage up your return on equity. All right, so the net profit margin, we can see that in terms of profitability or sales profitability, Coca Cola handily beats Pepsi Cola, about 15.5% to on average 10%. So Coca Cola has higher profitability, but they have lower efficiency. So Coca Cola doesn't make as many sales per dollar of assets as Pepsi does. All right, so one way to also interpret that, if you charge a higher rate for your your product relative to somebody else, you won't sell as much. So what we see here is when we get to return on assets, Pepsi Cola has a slight edge, and the Coca Cola used to have an edge, but it's been declining, and mostly it's declining because the profitability is declining. But we also see an erosion here in the sales per dollar of assets. The financial leverage, if you multiply the equity multiplier times the return on assets, you get the return on equity. And we saw from the debt ratios that Pepsi Cola is far and away uses more liabilities in its capital structure. They have about $75 billion in assets, and roughly 75%, 85% of those are funded with liabilities, as opposed to the 90 or so billion dollars of assets for Coke, which are funded with only roughly 75% liabilities. That leverage, the leverage factor here, those are fairly close. All right, again, Coke's has been declining, but there's still not a whole lot of difference in the return on assets between the firm. But that huge difference here in the equity multiplier makes the Pepsi return on equity twice as high. Notice that both firms were nearly identical in 2012. If you look at the 2012 numbers, Coca-Cola had twice the profit margin, but the total asset turnover was roughly 60% of the efficiency at Pepsi, but Coca Cola still had an edge on return on assets. but Pepsi used more financial leverage, and they ended up with roughly the same 27.5% return on equity. Pepsi has been increasing its financial leverage. Coke as well, but not as much as Pepsi. Pepsi's profitability has stayed stable. Its total asset turnover has stayed stable, so its asset efficiency. So you have fairly stable return on assets. Coca Cola's have declined. There is a slight decrease in the efficiency and a fairly pronounced decrease in net profit margin, and their increase in the financial leverage is lower than Pepsi's. So as of today, Pepsi's ROE, or as of the end of 2016, the return on equity for Pepsi is twice that of Coke, even though they started the same place back in 2012.